Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hirimath, and along with me, Karanya Rao. Let's take a look at the headlines for this morning. Nifty is nearing 11,900. Pharma has bitten the bitter pill and is a top sectoral loser, something that we really don't see in our markets. Pharma always seems to be performing well. Today that's taken a bit of a turn. Also, barring realty and media, all your sectors are in the red. So definitely a bit of a shaky start for the market this morning. Then moving forward to a data breach, we have DRL in focus as it shuts all key plants globally due to a data breach. So this is obviously around some information security, and we'll be bringing you more and more updates on that one as well. Then let's keep it with pharma, but some US FDA pain, a very important development for Aurobindo. There has been some warnings issued by the US FDA, which are not too good for its operating units. So you might see curtailment of production at some of its units. So keep an eye out for that counter as well. We then have earnings today, a lot of candidates that are very important. You have Asian Paints, Bajaj Auto and Ambuja Cement. All will be putting out their earnings today. So very important numbers, keep an eye out for that. Now, in terms of earnings that have been made and what's coming up, Bajaj Finance had a call yesterday, post its earnings, a very strong call. They're trying to get back to pre-COVID levels, still struggling a little bit, but the credit cost guidance is very good, and those counters are also fairly active in trade today. Then we have Taj on the prowl amidst all this issue that we're seeing with hotel companies. Indian Hotels is actually looking to make an overseas acquisition. They're in talks with Mabadla to buy out Viceroy Hotels, which will give them access to a foreign portfolio of hotels. We then have some shine coming in from the metal sector. We have copper shining. Copper prices globally have hit a 28-month high of $7,000. That's very key, and it's a key economic recovery tracker as well, as Mubina was sharing earlier in the day. If copper does well, it seems the economy is recovering. Two more items on our headlines for today. We have tepid listings of Hemisphere Properties, which went to lower circuit, listing at 106 apiece. That's a demerged Tata Communications land. And then finally, in terms of IPOs on the cards, Gland Pharma has received a nod from SEBI for a massive 6,000 crore IPO, which will make it again one of the largest issues we've seen in recent times behind an SBI cards. But back to you, Karanya, for a comprehensive check on the markets.
All right, turning back to the markets then, if you look at the benchmark indices, after 4 straight days of gaining, the markets seem to have taken a bit of a breather today. You have the Nifty trading just above 11,900 point with a loss of about 0.2%. Sensex down about 60 points. Broader market also trading lackluster at the moment. Mid-cap index is up by just about 20 odd points. Small cap index also gaining about 12-13 points as we speak. Advanced decline ratio also in favor of the losers at this juncture. You have 20 stocks advancing and 29 stocks losing in trade. Let me tell you which are the sectors that are putting some pressure on the market today. You have the pharma index bleeding about 2%. There's about 0.5% loss coming in for Nifty metals. Nifty auto also is in slow lane. Nifty IT is down 0.4%. Select names from FMCG as well as PSU Bank basket also trading weak at the moment. What's capping the downside is Nifty Media, Nifty Realty, and some private sector lenders, and also some names from the oil and gas space as well gaining steam in trade. The top gainer on the index today is Tata Motors, is up 1.5%, followed by Britannia, which is also equally gaining in an equal quantum. ONGC is also up 1.5%. So is Bajaj Finance, Bharti Airtel, Adani Ports, L&T, Axis Bank, Bajaj Finserv, all of them gaining in the excess of 1% each. On the flip side, you have DRL, top loser on the Nifty 50 today. It's down about 2.8% in trade, followed by another heavyweight from the pharma space, that's a Cipla, down 2%. Of course, DRL has a completely different trigger, which we had flagged off, and through the course of the show, we will get you details on the big DRL story that my colleague Ajay had done earlier on. Hindalco also looking quite weak, down 1.7%. iShares and Hero MotoCorp both losing about 1.5% each. Nestle, Sun Pharma, Grasim, earnings candidate Asian Paints also looking pretty weak as we speak. Let's touch base with our guests on the show, Kunal Bothra as well as Ashish Kapoor. Good morning, gentlemen. Thank you so much for taking time out. Kunal, coming first to you, what are your high risk and low risk bets for the day?
So good morning, Karanya. Interesting market. I think after yesterday's a bit of a tumultuous and volatile market, it's all of a sudden a calm for the indices. So it probably indicates that yesterday's shake-off could probably a precursor of a pending consolidation for the indices, and that's where I believe that a lot of the mid caps and tier to large cap names could probably get back into action. So my focus is on that segment particularly, or the ones which have shown signs of potential but are impending towards a breakout. So two buy calls over here. First one is a buy on LIC housing. I think it's a very interesting chart in Karna, because on the medium term time scale spread over the last 2 months, I think from August end and September start, the stock is forming a inverted head and shoulder pattern, and surprisingly, it's not a a reversal pattern. It's more of a continuation pattern. Now these patterns are a bit rare to find, but they generally lead into a strong trending breakout for stocks. So I believe LIC housing could be one stock which can continue to move up higher from current levels. It's also crossed and confirmed a close yesterday above its 200-day moving average. So LIC housing is the first buy. Targets to be kept at 340 and stoppers to be kept at 285. The second would be Adani Ports, again a stock which has had shown signs of, I would say, consistent attempt towards a break of 360 mark. Every time the stock managed to touch that 360 level, you saw big retracement and reversal happening into the stock. But it seems like with the markets being powered with the other large cap names, I think even Adani Ports can probably provide a breakout on the upside. So that's also a buy. Short-term targets to be kept at approximately at 380 and stoppers at 350.
Okay, thanks for that, Kunal. So LIC Housing and Adani Ports, those are the two picks from Kunal this morning. Ashish, hi. What's on your radar as far as a high risk and a low risk idea is concerned?
Well, I think the market is very well poised now. The low hanging fruit has been more or less been taken out. It has to be more stock specific approach from here. But the market momentum and the sentiment is very positive. So yes, it's a great time to look at stock ideas. Now, when it comes to high risk, my idea is DLF. And the reason is that real estate as a sector seems to be doing much better than what was feared. When the COVID crisis started, it was a big fear because one was feeling that a lot of commercial and office spaces would go vacant. To some extent, yes, that has played out, but the situation seems to be much better than what was the fear. And that is one reason. Another is, of course, the sector has been a real underperformer for many, many years now. So yes, it's under-owned. Any kind of upside surprise here could really take the stocks higher. And coming to the stock itself, I think DLF is also doing fairly well. The current trigger is the deal which they have signed yesterday with the Standard Chartered Bank, 7.7 lakh square feet of office space in Chennai. The project, of course, is going to take time in coming up, probably 3 years from now. So yes, no immediate financial benefit, but gives a lot of confidence to the kind of development which is happening, and certainly removes a lot of fear which was gripping this sector. DLF on its own also has been doing very well, consolidating its space in the real estate market. They have moved out of all the unnecessary diversifications, whether it was hotels or cinema halls, etc. And the cash in the balance sheet has really been improving over the years. The debt service ratio has really become much better. That was a fear which was holding this stock down earlier. So I think on nearly all fronts, including the fact that in North India, especially Delhi NCR market, this remains one big player still standing. Many of the other of the erstwhile players have either fallen completely on the side or have become very weak in the execution because of the debt which they are carrying. So it's clearly going to capture more market share going forward. So I think this is a very under-owned stock, out of focus, but has a huge potential on the upside. So this is a high risk, high return stock which I have, and I have a target here of 250 rupees with 1 year's perspective. When it comes to low risk and stock, then my idea is PI Industries. The stock has been doing very well, and I think this would continue going forward. Here I have a target of 2500 with a 1 year's perspective. The risk here is not much because the company is doing very well, and I think the next 3-4 years again the revenue would double and the net profit would grow at about 35% CAGR. The company is specializing in offering complex chemical solutions, and they are very strong both in agrochemicals as well as in the pharma space. Recently, they have managed to raise 2,000 crore through a QIP, which they plan to focus on improving their value chain in the pharma space. They are getting into various pharma intermediaries which are currently imported. So the market in the domestic is going to be very good because currently there is no player which is doing these pharma intermediates. Both in the pharma as well as the agro space, the company is doing very well and going in for a huge amount of custom manufacturing, which is their strength. So really speaking, there should be no surprise here. It can be the stock can continue to do well and reach 2,500 in less than 1 year's time. So these are two stocks: DLF on the high risk, high return category, and PI Industries on the low risk but decent return category.
All right, thanks Ashish for your fundamental calls for the day. Let's talk about some queries that we've received from our viewers as well. First up is an email from Rahul Sharma based in Delhi. He has bought Bharat Forge at 620 levels and wants to ask our experts if he should continue to hold on to it or should he book his losses and exit. Kunal, let's talk technicals for Bharat Forge first. It's been a good uptake seen for Bharat Forge over the kind of carnage, since the kind of carnage it witnessed back in the month of March, right now trading at 450 odd bucks. It even touched and crossed 500 levels about a month or two ago, but it's once again been range bound in that 400 odd levels. Where do you see it heading in the near future or over the medium term, or would you recommend somebody who has bought it at a 620 level to continue to stay put?
Well, I would advise the viewer to stay put on Bharat Forge. The only catch over here is that the stock may take a lot of time to come back to 600 plus levels. The last 2 quarters have been extremely good for the stock, from 200 levels to almost a 500, which the stock tested I think last month or the month before that, and then it's now going through a consolidation. So the only catch over here, Karnya, is that the stock may take some time to consolidate. It may probably take maybe another 3 to 6 months to try and surpass about that 500 mark and give you some strong consistent returns. So if the viewer is patient enough, and I'm assuming that he's managed to hold on to the stock at least for the last 2 years, because that's where the stock was about those 600 levels. I think if you can hold it for another 1.5 or 2 years approximately, then I would be of the belief that the stock should come back to not just your cost price but even go above that. And to top up on that, I think what you can also do is, if you have extra cash and you want to deploy on Bharat Forge assumingly, then I believe that I think at 400 levels, 400 and 405 kind of a zone, I think that's a good enough range where if the stock happens to consolidate and come back, I think that's a good level where you should look to average. Try and bring your cost price lower to as much as 500. I think that would be the net average cost for your holdings on on Bharat Forge, and that's where I believe you can stand a better chance of not just yielding returns but trying to be in profit much sooner. So my advice would be hold, and if you're looking to average, then I think just around the 400 mark is where I would advise the viewer to average at those levels.
Okay, Ashish, how do you feel about a Bharat Forge? Do you think at the current levels it represents a good investment opportunity? Would you wait for correction? And then, of course, what's your long-term view on this one?
Well, certainly the investor can hold on to his investment because I think the worst is behind us. The company is a leading player in the forging industry, and besides automobile, they also cater to various other industries, which includes defense. And a big positive for them is the current plan of the government to discourage imports in defense and putting a lot of defense equipments in the no import list. That should certainly be a big positive for this company. Overall, it's a fairly well-established company in the forging space, and in the current environment, it's still doing well. I think the results as well as the forecast is not at all negative. So certainly a stock which you can hold on to. Fresh investments, well, I would not perhaps buy this stock at the current price. I would wait for a correction or a lower tick to suggest a fresh buying. But yes, if you already bought at high levels, it makes sense to hold on, because eventually I think it is a leading player and the industry is definitely limping back to normalcy, and over a period of time you should get back your purchase cost, at least, if not a profit. So hold on for the moment, but do not buy fresh at this stage.
Okay, great. Thanks for that, Ashish. So you're of the view that he should continue to hold and that eventually it will come back to the historic levels that we've seen not too long ago. Let's move on to query number 2. We have Vijay Chabria writing to us, and he wants to invest in Bajaj Finance. He's heard that the Q2 call yesterday was particularly good. Good commentary on NPAs and growth. But his question is it safe at the current levels? Do NPA and growth pose a future risk? So Kunal, let's come to you first, purely on the chart. Do you think Bajaj Finance can breach 3,000 again and Vijay might get a better entry point? Or do you think that he should just get in now and then wait it out for the long haul?
I think you should get in now. I don't see any reason for the viewer to try and wait for too long, because what the stock has done is, in the last 4 months from July, the stock started to enter into a consolidation. It was at 3,200 in the month of July, and now we are in the month of ending the month of October. And so the stock has consolidated for the last 4 months at this 3,200 range, plus or minus some 200, 300 rupees from these kind of levels. But I believe largely that this is the kind of range Bajaj Finance has already been. So it's gone through that time correction, which is warranted for a stock to try and move to a next level. Now look at this in the context of how the overall markets are doing. The overall markets are doing pretty well. You have each sector trying to participate in every phase of the market rally. So I think it could probably be a time where the financial services names or the HFCs could probably also see one more round of upside and a strong participation in the next trend of the indices. So since my view is bullish, I would be of the view that financial services stocks, they would also try and make a strong comeback. I would advise a buy on Bajaj Finance at current levels, provided the time horizon is sufficiently long term.
Okay, and Ashish, your view on Bajaj Finance, especially that the viewer wants to know if it's a safe bet or NPAs continue to pose future growth risk. What would be your sense on that?
Well, I think if the viewer has a long-term view, is not necessarily in a hurry to make money, then this is a great stock and a great entry point, because NBFCs have been under pressure. But having said that, I think this stock is clearly the leading NBFC player, and the company's results have also been encouraging in a very tough environment. They have managed to hold on to their asset quality. They have increased their assets under management, total assets which they have, and also improved their net interest income significantly. So I think in a very tough environment, the company is able to perform well and also keep its, very importantly, keep its asset quality good, which augurs very well. So immediately, yes, there are a lot of worries on the NBFC front. So maybe it is not a sector which is going to be a favorite in the very near future. So sentiment-wise, perhaps it will not get too much of tailwind, at least in the very near future. But if the investor is a long-term investor, this clearly is the leading stock in this space, and the company has done very well to grow the way they have. They have a very large percentage of the market share and very good systems in place, very process driven, and very good quality control. So clearly a very good leading player in this segment. So with the long-term perspective, these are great opportunities to buy when the chips are down. So yes, if you have a 3-year plus kind of a time horizon, certainly go ahead and buy. But short term, I doubt whether this really can do well, because the sector would remain under pressure for some more time.
All right, gentlemen, thank you so much for joining us and helping our viewers out, as well as always a pleasure chatting with you too. Slipping into a break here, more updates on the other side. Stay tuned. for watching Buy Now, Sell Now. Time to address our BNSN quiz for the day. We've just given you a quick reminder of what the question was, and if you still want to participate, you can send us your answers on our Twitter handle. The question we asked was, who is the largest Indian tractor financier? The options were M&M Financial, Shriram Transport Finance, L&T Finance and Industar Capital. If you still want to participate, you can log on to Twitter and tweet us your replies on our ET Now handle, ET Now Live. Moving on then to some more individual stock related updates. Call it an ET Now impact. Let's pull up a DRL stock, Dr. Reddy's, and see how it has come down crashing. Key DRL units have been shut because of a data breach. This is a story that Ajay has picked up exclusively, and he broke it right here on ET Now earlier today. The stock sulking big time in trade, down almost 3%. Ajay joins us with all the details. Ajay.
Well, we are picking up from sources that there has been a data breach and kind of an intrusion at the servers of Dr. Reddy's, one of the largest pharma companies in India, and because of which the servers have been shut down. We understand that as a precautionary measure, the company has also taken a complete shutdown of all the key plants globally, which include plants in US, in Brazil, Russia, India, Hyderabad plants. All of the plants have been shut down right now. The company is trying to figure out what exactly is the breach and intrusion and how much time will it take to get the plants back. Sources are telling us that the IT department along with the top management is working on it on an urgent basis, and we spoke to the management about it, but they refused to give any comment about it. But this is one of its kind breach, data breach, intrusion which has happened in the servers of Dr. Reddy's. It is very important because servers do hold all the critical information of all the plant, of all the key drugs, molecules, etc. They are dealing with sensitive information, comparative information, so it's very important. However, it's reasonably serious that this matter has actually happened, and we've heard globally too data breaches have actually, the incidences are only occurring faster, but a pharma company, a large pharma company has fallen, have taken a hit because of this. To something to watch out for. We understand that the top management is taking measures to speedily to arrest this issue and get the plants back, but something to watch out for. This happened between 4 p.m. and 5 p.m. US time is what our sources say, and right now we understand all the top management along with top IT guys are actually working to get things back. But this is a important issue which has just occurred, unfortunately, for Dr. Reddy's.
Okay, that was a very important pharma update on DRL from Ajay, but metals are also in focus today, really a focus area of the market. We have precious metals and non-precious ones that are all off their recent lows, and it seems that they may be getting up now for the next big leg of the rally. Aluminum prices at an 18-month high, followed by copper. But let's cut across to Mubina, who's done a detailed study of what really is driving the rally and whether it can continue or not. Let's listen in.
Well, the rally really is accelerating, especially in the last couple of days. Copper is at $7,000 per ton. Nickel is here at yet another, milestone of $16,000 per ton. So both of these are at multi-month highs. Copper, in fact, is at a 2.5, or rather a little over a 2-year high. And aluminium really, especially in the last couple of weeks, has seen an accelerated catch-up, if you could call it, with its base metal peers. Remember, the aluminium compared to the other metals was still a little slow in recovery. If we look at the sort of rebound we witnessed from the lows in March and April, it's really copper that's shown the brightest. 60% of a rebound from the low point in March and April. Aluminium has lagged a little with just a 30% rebound. Factors, of course, are your usual US stimulus hopes. You have the China consumption bit as well. Remember, there was LME week too. There were seminars being held, and there was this renewed focus on clean energy, on electric vehicles, etc. So that sort of gave another push up to nickel, which is a prime raw material used in the entire EV space. But there's one interesting tidbit I'd like to flag off for our viewers, and that's something called as the gold-copper ratio. These two make I guess, unlikely bedfellows, because copper is usually an indicator of how the economy, economic activity is sort of shaping up, because copper is used largely in almost every sphere of industry. Gold, on the other hand, is more of a safe haven. So when things are going awry, you turn to gold. But interestingly, this ratio is now extremely high. It's at 10,000. The average during 2016 and 2018 was 6,000 to 8,000. So that as well is an indicator. Clearly shows that copper has a lot of catch up to do still, despite the fact that it's already at $7,000 per ton versus gold.
All right, Mubina, thanks much for that update. Meanwhile, another pharma major that's sulking in trade is Aurobindo Pharma, down almost 6% as we speak. Yes, 5.5% down for that one. Why that is? Because the company has received a warning letter from the US FDA for New Jersey unit. The facility is essentially based out of Dayton. It's got a warning letter which indicates no fresh approval from facility. The letter follows an earlier one that was dated on 4th of June 2020, issuing an OAI status. The existing business from this facility, however, the company has said will not be impacted. The company will be engaging with the regulator and is committed in resolving the issue, they said. But definitely, as of now, the market seems to be punishing this stock. Moving on to another stock in focus, Bajaj Finance. They handed over their Q2 report card yesterday, and they've said that the quarter was about gradual unlocking, and going forward the focus will shift to business transformation. Listen in.
From the month of September, the company has started to accelerate volumes across all businesses. We do expect even bureau data to go fully on stream by November, which should further add volume momentum. Please do realize that bureaus are the quote unquote the radar on which the consumer credit in any part of the world works. It is a headwind, and from an information availability standpoint. Let's talk September. September, clearly, let's break this into three parts. There are a set of consumption businesses that we are in. The urban consumption business came in year on year at 72% of monthly volumes. Rural is starting to be back virtually close to 100%, came in at 91% of year on year volumes. Credit card origination at 73%. E-com came in at 75%, and auto finance was at 54%. If you look at loan businesses, which is whether it's personal loans, mortgages, rural personal loans, SME, were at 60 on an aggregate basis at 62% of last year's volume. In the current quarter, company acquired 1.2 million new customers. Overall franchise stood at 44.11 million customers. Point number 7, AUM moderated to 1%. We talked about it. It's 137,000 crore. We expect now the AUM growth to be at 6 to 7% versus 9 to 11% that we are actually given you in Q1. If the momentum by Q4 is stronger, which is possible, there may be a potential upside.
Okay. Bajaj Auto's Q2 numbers are also expected to be out, and it seems to be that the brokerage poll is indicating quite a muted outcome for them this time round. But Karanya, what are you gathering from the brokerage poll? What can we expect from Bajaj Auto's Q2?
Well, it's definitely going to play out much better than Q1 did, given the significant part of the quarter. The first quarter was because dented by the lockdown. Q2 is likely to be better, so sequential improvement definitely seen. As far as volumes are concerned, we saw a 10% downtick in volumes overall for the quarter gone by, and despite sort of lower mix of three-wheelers, the ASPs are likely to increase and also aid the sales figure as well eventually, because of the price hike of BS6 transition, and also because of rupee depreciation. So we're expecting revenue to come in at 7,250 crores. PAT is seen at 1,210 crores. Margins are healthy expansion seen on a YOY basis from 16.6% to 17.7%, 110 basis points expansion. Why that is? Because of rupee depreciation, better two-wheeler mix in the domestic market, cost reduction efforts, commodity prices being stable. So all of this is likely to cushion the margins in a big way. There are a host of monitorables now that we need to watch out for. Last quarter has been unprecedented. Management also said three-wheeler segment will take some time to pick up. So an update on the outlook for three-wheeler segment will be important to watch out for. Has there been any down trading in the two-wheeler business? What is the recovery trend in the Indian market overall that's playing out? Outlook in key export markets, especially in the African region, domestic festive demand, inventory levels, launch pipeline. So lots of things to watch out for. Let's see what the management really and finally addresses. But definitely Bajaj is an important one to watch out for, especially from an export play standpoint as well.
Okay. Thanks for that, Karanya. So that was Bajaj Auto and what you can expect. Keep an eye out for that counter today. But another one that's definitely in focus is Asian Paints. And I'm just going to walk you through the Q2 poll. Revenue seen at 5,200 versus 5,050, so up 3.2% marginally. EBITDA is expected to improve much more at 16.3% at 1,110 crore versus 954. Margins also are seen or expected rather to expand at 21.3 versus 18.9. So it seems that there are some marked improvements, but revenue growth is a bit muted. Volume growth this quarter, we're looking at around an 8% figure. And a small price cut with discounts to slash average realizations is another factor to keep out for as well. So particularly volume growth, sales mix, and then management commentary on the growth pace sustenance will be key monitorables. So that was Asian Paints. Recently, today rather, we had Hemisphere Properties, which used to be part of Tatacom. It's now demerged as its own real estate entity. It's got shareholders from VSNL, Tatacom, the government, and it had a bit of a shaky listing, went to lower circuit soon after. Vivek's going to walk us through what this company is, what the ownership's like, and what it does for the various shareholders. Over to you, Vivek.
Well, in a very interesting development, Hemisphere Properties listed on the exchanges. It was an extremely weak listing with the stock locked on the lower circuit on both of the exchanges. Now, what exactly is Hemisphere Properties? Hemisphere Properties was actually an SPV that was formed for holding the land bank of VSNL when Tata Communications actually brought over the telecommunications business of VSNL. So the government put aside the land bank of VSNL in a special SPV, and this SPV was Hemisphere Properties. What Hemisphere Property owns is only a land bank. There are no operating businesses as of now. Almost 740 acres of land bank is what they own. Now, when you're talking about the shareholding pattern of Hemisphere Properties, remember, Tatacom shareholders receive shares in the 1:1 ratio. Shareholding pattern, government owns 51%. Tata Communication owns almost 4%. Tata Communication minority shareholders who receive shares in the ratio of 1:1 hold 25%. While VSNL minority shareholders own almost 20%. It's been a weak listing, and there are a lot of concerns regarding how and when this particular land bank can actually be developed on back of the fact that if you're talking about some of the areas where the land is present, it is very tough for the company to actually go ahead and make any developments over there. So land demerger and listing that was held up for a very long time due to a legal technicality now resolved, and so it is listed. It offers an opportunity for Tata Communication shareholders as well as shareholders of VSNL who tendered their shares in the open offer to get an exit when this particular stock has actually been listed on the exchanges.
Yeah. Thanks, Vivek, for that update. Meanwhile, the Prime Minister will be meeting 15 of the world's largest funds to promote investments in capital-starved sectors like infrastructure. Tarun Bajaj, the Secretary of Department of Economic Affairs, said that the top global fund houses are in touch with us and they want India to provide good assets with stable returns. Listen in.
One of the things that we have actually done, I'll again repeat on the InvITs only, that now we have got two public sector, central public sector units like the NHAI and the PGCIL, which are also setting up these InvITs, and I'm sure we have made some suggestions from our side also that similar assets can actually be monetized in the other departments. So this can actually be replicated. The other thing which I mentioned to you, which I'll repeat, is that there's a lot of capital which is available within the country and it is now increasing. Unlike 10 years ago or 15 years ago, that money was not available. So some kind of, for example, the EPFO. The EPFO has been more than active, I would say, to actually consider tinkering with some of their regulations to see that what money they can put into this sector. So are we trying with the insurance regulator and the pension regulator. As compared to what the regulations were a few years ago, they have actually allowed some movement on that side, but I think a lot more needs to be done. The third thing which is there is that you actually have these fund houses from all over the world. They're actually getting in touch with us and saying that if you can provide us some good assets which require patient capital and gives not very high returns, but stable returns. So that is another area that we are looking at, and the Prime Minister is soon himself going to meet about 15 leading houses from the world to have an interaction and to get their views. So these are some of the measures we are taking. There are many others. We are using multilateral funding. We are using meeting with JICA. JICA is ready to fund. So all that money is coming, but most of that money would come in the government sector. So in the National Infrastructure Pipeline also, we are working in terms of how much money can come from the government sector and how much is required from the PPP and what are the various models of PPP that we can work on.
Welcome back. You're still watching Buy Now, Sell Now. Time to get you the answer to our BNSM quiz of the day. This morning, we asked you which of these is the largest Indian tractor financier, the options being the M&M Financial, Shriram Transport Finance, L&T Finance and Indostar Capital. And it's time to reveal the correct answer, which is option A, M&M Financial Services. Thank you so much for everybody, all of those who participated and sent us their right answers. We have two quiz champions who tweeted their replies earlier on and were the first ones to get it right. First is Chakri John and the second one being Hari. Thank you so much for everybody for participating day in and day out and for sending us so much response and so much of your love. Thank you so much once again. Let's talk about Times Network's initiative, which keeps interests of you, our viewers, at the forefront. Taking that step ahead, we've launched a special awareness series called Nivesh Ke Fund that will guide you on managing your personal finances better. Today, we're looking at a very important aspect of personal finance, asset allocation. What it means, what is the importance of doing that correctly? Let's take a look and find out.
But asset allocation and diversification, it's actually a crucial part of managing one's finances, but one that's often overlooked.
You're right. And while mutual funds are a great vehicle to achieve optimum asset allocation, one particular type of fund is more ideal.
You mean the multi-asset funds, right? These funds are incredibly efficient for an investor to manage their assets because they allow investments into mixed assets like debt, equities, cash, gold, and so on.
Yes, Abha. And the biggest plus point is the seamless asset allocation composition between the different asset classes, depending, of course, on the market situation.
Yes, exactly. Most investors prefer to invest in limited asset buckets because they're either comfortable with those assets or they feel those assets are the ones that will give them best returns over a period of time.
But you know, the performance of asset classes as well rotates. It rarely happens that one particular asset class consistently tops the charts every year.
Exactly why ensuring diversification in your asset allocation is incredibly important.
And as the age-old saying goes, don't put all your eggs in one basket. That's all on this edition of Nivesh Ke Fund. Do stay tuned for many more such investment insights on the Times Network.
Okay, I hope all our viewers are finding this Nivesh Ke Fund series beneficial to them and to their knowledge of the markets and how investing really works. But switching gears on TMS, interesting guest, but let me give you a bit of an intro. Almost 51% of Indians do not have a proper retirement plan, and 89% feel unprepared. Moreover, retirement planning is last on the financial priority list. That's what PGIM India's MF's new Retirement Readiness Survey 2020 observes. On the Money Show, we caught up with Ajit Menon, who's the CEO at PGIM India MF, who says retirement planning must take precedence for Indians. One can get a loan for any ambition, home, car, etc., but you cannot get a loan for retirement. Let's listen in.
We don't have social security in India. It's better to be conservative. So 30 times your annual expense is a good number to think about as a corpus that you will need for retirement when you reach the age of 60. But here is the real issue, which many other people have written about in the media, which is this whole thing about not factoring in inflation when you're thinking about that corpus and thinking too simplistically on it. So to give you an example of that, and what I would probably recommend for people to think about in a very general thumb rule sense, is to use the rule of 72. A lot of financial advisors use the rule of 72, and I'll tell you how to use it. So for instance, if we think that today inflation is 7%, right? If you use the rule of 72 divided by 7, it will tell you that whatever is the amount that you are today spending, it could double in 10 years' time. 72 divided by 7, roughly. So I'm taking 10 years' time. So now let's use this. If you're a 30-year-old, you're spending, let's say, 25,000 rupees a month for the average Indian. That's about 3 lakh rupees a year that you're spending today at the age of 30. With an inflation rate of 7%, and use the rule of 72 divided by 7, so things are going to double in 10 years' time. By the time this 30-year-old is 40 years old, his 3 lakhs of annual expense is going to become 6 lakhs. By the time he's 50 years old, it's going to become 12 lakhs. By the time he's 60 years old, that becomes 24 lakhs a year. That kind of scale and that compounding is where people get stuck and have a problem with. 24 lakhs expense by the time you're at 60, if inflation holds at 7%. And if you have to have...
That note, completely out of time here on this edition of Buy Now, Sell Now. Thank you so much for tuning in. Keep it with ET Now. Markets at noon coming up next.